now that we covered assets and liabilities, we covered income, we got to now cover expenses. So what we're going to do is we're going to review how to add expenses in eMoney. Given the fact that eMoney is cash flow-based software, it's really important that we understand expenses and understand the why behind each one of these categories. So let's dive right into it. So we have a sample client up here, Don and Betty Draper. And we're going to click on the base facts here. If you're not familiar with this, we want to be in basic facts. So if it doesn't look like this, go back and listen to my eMoney 101 on why we use base facts. I also haven't pointed this out, and one of my goals is to try to do this in every section, to point out you should be in here in present mode. Notice how I'm in present mode. If that doesn't sound familiar to you, go back and listen to my eMoney 101 in my introduction where I talk about this. But if you've been following along the entire masterclass, you're familiar with this, get this habit. I don't care whether you meet with clients or don't meet with clients. Every time you close your software, be in present mode. So when you come back, you're in present mode. Also, the vast majority of everything you need to do, you can do inside of present mode. I would say it's probably 90%, but 63% of all statistics are made up on the spot. So how much do I know? How much is it actually, but it's somewhere high like that. So let's talk about expenses. We go to expenses and taxes tab here. And we have to understand a basic breakdown of expenses inside of eMoney. I know this could sometimes be one of the pain points of eMoney for a client because they hear living expenses, they think it's all encompassing. But we find that once we explain to clients why it's set up this way, they love it and they understand the expenses better. So what are living expenses? I like to tell my team that think of living expenses as perpetuity expenses. They last forever. It's not really forever, but that's the way we talk about it. There's 4 triggering events that could stop this. One is death. One is retirement. The other one is going to be advanced age, and the other one is semi-retirement. Those are your 4 triggering events if it's under living expenses. It's also important to point out here, I get this question all the time, Greg, what should go in living expenses? The one I get all the time, and you'll see when I go through the other expenses why this becomes important, should childcare be in here? Because there's not a triggering event that my child went to kindergarten or my child went to 1st grade. So it's very easy to put that in other expenses when we talk about it, we put a date on it, and we can say from this date to this date. So what we often see with a lot of clients, we work a lot with busy working professionals, and they might be paying for daycare. And then all of a sudden their child enters public schools at kindergarten or 1st grade, depending on their state rules, and they no longer have this expensive childcare that might have been a pretty substantial expense for them. Well, often we actually put that in living expenses. And the reason why we do that for our team is what we've found with the majority of the clients we work with, they don't capture that expense back into wealth building. See, this is cash flow-based software, so it's really important. And when we go to spend year-end cash, it doesn't matter if it's being spent on childcare or it's being spent at the movie theater, it's being spent. So the only way that we're gonna not put that in living expenses is if our clients think they're gonna recapture some of that, and we might show increasing 401k contributions, or maybe it's contributing to the 529 plan for the child, or a UTMA up my account for the child. But that's where we would move it in or out of here. But we typically default, and it allows us to have a great conversation with clients about what do you plan on doing to recapture that. But the living expenses should be your basic things like your utilities. Another one that we put a lot of times in living expenses, depending on the client, what they have going on, if they have no car payment, we're actually going to put a car payment because they plan on buying another vehicle in retirement, right? It's getting past it, okay, that liability of car expense goes out. We got to recognize this is going to be a perpetuity. They're going to be paying for maintenance of a car, whether it's inspections, which we have here in Pennsylvania, we're based out of. It could be tire rotation. It could be basic maintenance and support of the car, or purchase a new vehicle however many years. Just be careful because that might be double counted when you get the liability and you put in a liability for that car. So really, really important to understand the living expenses are going to be the basis of your plan. When we go to that cash flow report, the granddaddy of them all, that living expense is going to be one of the columns. We're going to come back and dive further into living expense. We're going to talk about expense worksheet, and we're going to talk about this semi-retirement and advanced retirement, which might be new to you if you haven't seen them in here because you might not have them in your settings. I did address these back in eMoney 101. Next, you're going to see is liability payments. Liability payments are already going to be introduced when you introduce that liability. So we already covered that in the last section. If you need more help on that, go back to liabilities. The next one you see come down here is going to be education goals. You might not need education goals. Maybe you're working with a client that has no desire to work on education goals. Maybe they don't have children. Maybe they don't plan to further their education. But this is not going to be for student loans. That's going to be under liabilities. This is a future goal, right? Goals-based planning. There are many ways to input this, by the way. A lot of people like to go into Goals Planner and do it there. A lot of times, too, you're going to actually click up in the goals. So if we're scrolling up here, if you don't mind, we're going to click in the goals. You can go up here to add, and you can add in all types of goals, right? So that's one way to get there. There's a couple different ways, so we're going to show you this way. And again, these are going to be different goals. So goals-based expenses are not just education, going to be other ones. So when we click up this tab, we're going to click education. And I'm going to go right in advanced. I love to be in advanced in this one. So many different things that we can do inside here. So the first thing we're going to do is name this expense. But I think the easiest thing to do before you do that is pick the child. So you always want to pick the child, or if it's a parent that wants to do this. But let's pick Bobby Draper. And what I love about this, I just want to point out what just happened here. Did you notice that these calendar years, eMoney automatically assumes that the child's going to go at age 18 and graduate in 4 years. Makes our lives a lot easier. Not every child do we have that planned for, but that seems to be the vast majority of children that we're planning for, so it really helps us out inside of there. Now we can go and say, let's call this Bobby Education. You can call Bobby College, right? However you want to do to customize this and personalize it. You can call it Bobby Education, whatever you want to call it. We're going to go with Bobby Education for right now. Then I love this worksheet up here. So if you click on this worksheet, this is unbelievable data here. So you're just going to go ahead and you can pick a university. My company's colors are based upon the University of Pittsburgh, held at Pitt. And so we are blue and gold because of my love of Pitt. So I tend to either use Pitt, but if I find out at any time where my client went to, even if it's Penn State and Notre Dame that I can't stand, or Michigan, those are 3 schools I can't stand. And I really don't like West Virginia, but I can at least stand it more than those 3. So we're big into colleges where I live. But I will typically use the alma mater. The more you can customize a plan, and we always like to say we don't customize plans, you personalize it. That's a whole other part of eMoney that I'll get to. But realistically up here, we want to look at the state, and then you want to pick the college. Just to be careful with this, because sometimes you might find it because it has the in front of it. I know the Ohio State University thinks they're the one that has the, but there was a client of mine who went to a school in Ohio, I believe it is, called Wooster, W-O-O-S-T-R. I actually had to call eMoney and say, I can't believe you don't have their data in here, and it was under the Wooster, so just make sure you check that. But it's really cool to pick the college. Also, when you print out certain reports, it's actually have the college logo. Unfortunately, they use about a 10-year-old logo for Pitt. It's our ugly logo, the days I like to pretend don't exist. So please, eMoney, someday, if you could update it to the Pitt script, I'd appreciate that. But when you go in here, that allows you to customize it. It's that small approach. But the other reason why you want to pick this is what it's going to do is it's going to pull information from the Department of Education. And it's actually going to give you what that school says its tuition, room, and board are. So we're just going to pick one of these here. Let's do University of Pennsylvania. That's a Ivy League school. A little bit expensive here, but you can see right here, it gives us the tuition costs. It also gives it for out of state. It automatically figures out what state the client's in. It figures out if it's out of state. You got your books, you got your room and board, you have your other expenses. This, again, comes from the FAFSA information from the Department of Education. You also have the ability to put any grants, scholarships, or outside funds that we plan on doing in here. So I do love this tab. So now we want to look at funding. And so we're going to go right up here to the funding tab. And what's great in here is we can pick the funding sources. So we can go up here and we can add a funding source. So we have a 529 plan that we've already created, or we have some other type of resource we want to use. Maybe we want to earmark this investment account for college. We can click in here. And so again, we have 529 plan for Bobby. We could do this one. So we're going to click on the 529 plan. And then we can decide 100% of the future value, or maybe it's a specific amount. So I have a client that has one 529 plan under one child's name, and they want to use it 50-50 for each child. So that's the way we do it in here. I don't recommend doing it. I recommend having 529 plans for each child's name, but there's a million reasons why we could debate that. Million's probably hyperbolic, but a lot of different reasons. So right now, 100% of the future asset value, so we're going to hit save in here. And so now, that's now out of his 529 plan. So hit save on there. And so we have that 529 plan. You'll be able to see the accounts that you have earmarked towards us. But this is the part that we love to do. We'll come back to this when we do techniques, but fund the expense through normal cash flow or stop funding the expense if this account's depleted. We tend to default on our team to stop funding the expense. Because now when we do this, it's going to go and stop saying 100%, because a lot of times what's happening is it's going to fund that with your accounts, which takes away from your retirement. And then we can create that technique to say, what if we were able to bankroll it? What if we were able to do that type of thing if this 529 plan? It also helps us isolate that from goals-based planning to be able to see if we're on target for that goal, which shows up in the client portal if you have the goals tab. So again, you can look at these 100% max funding level, in the event of death. That's really important in long-term care and disability. We leave those at 100%, but you also want to look at that for your team. That only comes up if we stop funding the expenses. So another one you can do down here is the saving rate for solution reports. We leave this at no growth, right? So when you create a solution, we're not working on that right now, so we leave that at 0. You can come back and we get to details inside of the planning. So I love this funding tab. Make sure you fill out this funding tab. Make sure you're using the worksheet tab. Timing is the same as timing anywhere. You can decide what timing this event comes in. And then you can also see the notes tab, right? And you can be able to put in some additional notes about this. We don't tend to use those two. And I've talked about that over and over again with other tabs. So this is education goal. Once we hit save in here, this education goal is going to be now inside of here in our goals tab. But it's also going to be if we come on our expenses, because we're in the expenses here, you're going to see now that it's under education goals. So it allows us to see quickly what that goal is, and we're going down through here. You're also going to see under other goals, Sally's wedding. If we go back up to goals, again, we hit add up here to goals. This is where we're going to put all these. So education, travel, home improvement, wedding, celebration, elder care, and other. We tend to use a lot of things in other, especially for medical, because we don't want to show the tax advantages of some of those medical expenses. We actually want to show it worse off. But this is where we're going to put time goals. Where we use this the most is we come in and create other expense for Medicare gap spending. So in other words, our client might retire at 62, and I want to show from age 62 to age 65, I want to show timed expense for medical care. And then typically from 65 of that spouse to 65 of the other spouse, I want to show medical care. We still have a medical column that's going to be in the living expenses because it's perpetuity, right? You got to pay premiums forever. You got to pay other medical expenses forever. And that's one of the things when we do with living expenses, we do a lot of things that people might not think through in retirement. So for example, home maintenance would go under living expenses. And right now you can actually put it under home. That's one of the upgrades of eMoney. We're still kind of getting used to changing that mindset when we sell that property. But any of those type of things of like, hey, you know what? And we always put a miscellaneous expense. You're probably gonna be over this, and we gotta show this cash flow wise out, because there are gonna be years where things come up, right, that you didn't expect. So let's get back down to expenses. So we covered living expenses, we covered liability, and we covered education goals. We've covered other goals and expenses. Again, that's where you typically see a Medicare gap expense or some type of limited. Another often one we get is, I want to travel for maybe 10 years in retirement. I don't want to travel for 20 years. Same when we do income, we'll put like a consulting income for a certain period of time. We're usually going to put that in there, not put at retirement when we get to living expenses, and I break living expenses down a little bit more. Next thing you have is insurance premiums. I'm going to spend a lot more time talking about insurance premiums in the next section. So the next section, we're going to talk about input to insurance. Those come just like liabilities through the input of that area. And then we have tax assumptions. Tax assumptions are based upon the assumptions, but it shows up the expenses because that's how expenses are broken down. Now that we understand these from a vertical way, let's go ahead and understand the same ones horizontally. Let's go into the cash flow report, the granddaddy of them all. And now we click on cash flow report. And we're going to click on total expenses down here. And now what we're going to see is each one of these columns represents what we talked about. Living expenses, liability payments, other expense cash flows, cash gifts and transfers, insurance premiums, taxes paid, and total expenses. We will use this with clients. We need to talk through this. And most often we use the living expense column. So when we click on living expense column here, if you have some type of difference that's making year-end spend cash, it's going to show up. So this particular client, we don't have this, but a lot of other clients you're going to see under living expenses, you're going to see a column right by living expenses that says year-end cash. That's where we say, look, there's actually $30,000 extra you're not using your plan. Where's this money going? Let's capture that. So that's one of the things we're going to use all the time in expenses and come in here and look at that. Again, it'll be a column right next to living expenses that we do go review this with clients. Again, we work with a lot of busy working professionals that are maybe spending more money, but often a lot of times saving more money than they realize. Can we get to systematic savings? So let's go back up here, and we're going to go click on facts, and we're going to click back down on expenses. Now that we understand the basic overview of expenses, we really want to drill into here towards living expenses. And we want to spend some time on living expenses. So let's click on current. You're going to notice that mine went right to this worksheet. Yours most likely didn't look like that. Most likely had a drop-up box and you just put a number in there. And it's okay to put just a number in there. We have a lot of clients, we just put a number in there. Look, the reality is we're never going to get them to do a budget. They're saving enough money. We don't have to make it overly complicated. If they make $300,000, and I know what they pay in taxes, I know what they're saving, boom, 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 the rest is just expenses. But I love to itemize it because we have conversations. We can start to say, what if we change these expenses in retirement? We can do the same thing by just changing overall living expenses. But if you do want to itemize out your expenses, you're going to want to create a worksheet. So you're going to want to build out a worksheet that like we have here. This worksheet actually matches what we have online. So if you go to our website and you go to financial planning forms, our clients can download a sheet. We'll take anything from a bar napkin all the way up to Quicken. I don't care if they use my worksheet or a detailed like Quicken or they use a bar napkin, but we want to start having these expenses in here. This also helps us to remember things that sometimes get double counted in living expenses, like mortgage payments, right? That should be on liabilities. Insurance payments, that should be in our insurance. It should not be in our living expenses. It also allows us, we do a custom growth rate of 3.5%. That's our inflation assumption as a team, so it allows us to build that out. You're going to notice this one says advanced years. You might be missing that, because remember I told you there's triggering. So it's going to be the current amount and typically retirement. And when you're inputting this, you can just literally hit this arrow, and it just takes it over there. And so it's going to say that in today's dollars is the same in retirement. It just has that 3.5% assumption rate. So what is advanced years and semi-retirement, the other two triggers? So if we go back to basic up here, you're going to see, by the way, and I love it. This is, I think, fairly new. I didn't notice it until like a year and a half ago, 2 years ago. It might be up there forever. But they actually have this thing up here like, do not put liabilities in here. And they actually have a quick thing to click here to go to liabilities in case you mess it up. But also, starting to get used to these columns on the left-hand side. These help columns are fantastic. They guide you through everything. But you're going to notice right here, it says, the living expense periods listed reflect the ages that were entered on the retirement and death tab assumption section of the fact finder. When we're under base facts, we can't find that. It's under advanced facts, under assumptions. And we already talked about making these assumptions as defaults in the earlier one. So if you want to have these for every client, you should have this set for your assumptions across the board. We find that most planners do not use advanced age and semi-retirement. But the planners that love to use it all the time. So let's click on this really quick, and this is going to take us into advanced facts under assumptions, and it's going to allow us to quickly edit this. Again, here's our living expenses, retirement, death. So semi-retirement age, you actually have to put something in here. So let's put in here for age 60. And so what this is, you're saying, hey, look, when I'm in semi-retirement, this is going to be a trigger that I could put on all different types of techniques, and I can change that semi-retirement age, and it changes those triggers. So it gives us another expense column. Same with advanced age. And the theory behind these is somebody when they're 80 doesn't spend away from 80 to 90 as they did from 70 to 80. So it allows you to say, okay, maybe at semi-retirement age, my expenses are going to go way up. At retirement age, they're going to be a little bit less. Or maybe these go up just a little bit. These go up even more, right? I spend heavily. And then when I get to my advanced age, my expenses are going to drop. That's how those are utilized. Again, we don't utilize them as a team, but that's not right or wrong. It's just who we are. So let's go down and let's hit save on this. Now it's going to pop us right back to expenses. You could have gone there through advanced facts. You could go to assumptions, but I think it's just an easier way to do this. So we're going to go back up to our current. And again, so we have these columns so we can put this in here. So we now have the semi-retirement, we have the retirement amount, and we have the advanced years. So really, really cool thing. So let's go down the bottom here if you don't mind. Oh, by the way, I forgot to mention one other thing here. Essentials up here. If you click on this, it's going to say it's essential. This helps you. And also the types. We don't get into the categories of the types too much. And one of the reasons why is it can change the taxes, right? So if it's education versus, say, a charitable contribution. So this is where you're going to really, from a tax standpoint of view, we like to rather show it overtaxed. But if we scroll down here, you're going to see right here we can always add entries. So one of the things I want you to know, if you load your default worksheet, again, if you load your default worksheet and it comes in with 0 numbers, it will not show up in the client portal. It will just show a tab for the client to enter in. If you want your clients to enter their own expenses in here, you're going to have to put $1 in every single one of these for the client to see those listed on the website. So if you go and name this, and whatever the heck you want to name this, let's call this, I don't know, eMoney Masterclass. It's an expense for this client. They're going to take these masterclasses and pay for it, right? Now, all of a sudden, this will not show up on the client website, but if I put $1 here, it's going to show up on the client website. So really important there if you do want to utilize this as a client data input tool. So the next thing you hear is click on Load Default Worksheet if you don't mind. And yes, we can confirm this. This is a sample client. I don't care. So now when I did that, it automatically loaded my default worksheet, and you're going to see it got rid of every single thing for this particular client. So really, really important to do that. So let's click Save on here, or hit Cancel on here. Yep. And now when I hit Cancel, because I didn't save that, right, it kept all my data that I have inside there. So the next question becomes, how do we create a worksheet? So I told you, you got to stay in present mode as much as possible. These are one of the features we're going to have to go out of present mode for this. So this client, we're going to hit Stop Presenting, and we're going to hit up to Settings. So we're going to click up here to Settings. And then now we're going to come down here, and we're going to go to Expenses. And we're going to look up here to Worksheet. And this is where you scroll down, because this is mine I already have in here. But you're going to click here, Add Entry, Add Entry, Add Entry, and hit Save. And whatever you put in here now becomes your default worksheet. So now we have that load default worksheet in there. It's really important now that we want to hit Start Presenting again. Get back into present mode. Always be back in that present mode. And so this worksheet, I think a lot of times I find that planners never built this out. It's such an easy hack. So we're going to go back to Facts. We're going to go back to Expenses. And under this one, in Current. And all you would do is you would come under here in the worksheet, you would scroll down, you would hit that load like I did last time. You already saw that. So again, it's such a useful tool. Let's go back up here if you don't mind. And we're going to go back to Basic. Just go under Expenses. Go back to Basic. If you have this where you just input it here and you didn't use the worksheet, you could quick edit here. Also, a lot of times when you're going in, you're doing techniques, you're going to just edit these ones inside of techniques. You don't have to get into too much of detail. Last part that's important is deciding how much the expenses are if one of them passes away. So again, you can go ahead and put that in there based upon what you're trying to achieve inside of there. So if we go back, the key takeaways in here is living expenses are going to have triggering events. Make sure you only put in there what you want to have changed at a triggering event. Liability payments are when you input the liability and they're going to go away. Goals, which will be education goals or other goals and expenses, are going to be put in as goals and are going to be a timed period of time, not that perpetuity that you see from living expenses. And insurance premiums are going to be input in insurance, and tax assumptions are going to be input when you have the assumptions for the taxes for that client. Now that we've covered living expenses, next time we get together, we're going to talk about insurance, how to input different types of insurance so that they flow through for the data input.